A special thank you to each of our subscribers who make this channel possible. Here's today's story. In a significant move aimed at reshaping the UK's tax landscape, Chancellor Rachel Reeves announced a series of changes to inheritance tax (IHT) rules that are expected to generate an additional £2 billion annually for the government. Despite the fact that only a small fraction of estates currently pay this tax, a considerable number of individuals harbor concerns about potential liabilities due to the complexities surrounding the tax structure and their aspirations for wealth accumulation. Under the current system, inheritance tax is levied at a rate of 40% on the value of an estate exceeding a threshold of £325,000. This means that for an estate valued at £335,000, the tax would apply only to the additional £10,000, resulting in a tax liability of £4,000. Chancellor Reeves confirmed that this threshold will be maintained at its current level until 2030, allowing individuals to plan their estates accordingly. As it stands, the inheritance tax system raises approximately £7 billion per year for the UK government, with the latest figures indicating that just over 4% of estates, around 27,800, are subject to the tax. However, projections from the Institute for Fiscal Studies suggest that this figure could rise to 7% by 2032 if existing rules remain unchanged. A YouGov poll conducted in July 2023 revealed that one-third of respondents believed they would be liable for inheritance tax on their assets upon death, underscoring the widespread anxiety surrounding this issue. The Chancellor outlined several exemptions and allowances that currently exist within the inheritance tax framework. Estates valued below £325,000 are exempt from tax, as are those passed on to spouses or civil partners. Additional allowances are available for individuals who leave their homes to children or grandchildren, raising the threshold to £500,000. Married couples can transfer their unused tax allowances to one another, potentially allowing estates worth up to £1 million to escape inheritance tax altogether. In her announcement, Reeves also detailed forthcoming changes to the treatment of inherited pensions, which will be included in the inheritance tax calculations starting in April 2027. Furthermore, the rules governing business and agricultural assets are set to change. While no inheritance tax will be due on these assets valued below £1 million, those exceeding this threshold will incur a tax at an effective rate of 20% beginning in April 2026. This shift has raised concerns among farmers, who feel betrayed by the introduction of a cap on relief for family farms that have traditionally been passed down through generations without incurring tax liabilities. Chancellor Reeves emphasized that individuals can gift up to £3,000 annually without incurring any tax, a provision known as the annual exemption. Unused allowances can be carried over to the following year, allowing for a maximum exemption of £6,000. Moreover, gifts funded from income rather than savings are exempt from inheritance tax, as are certain wedding gifts. However, larger gifts made within 7 years of death may still be included in inheritance tax calculations. The Chancellor hinted at potential changes to various exemptions, particularly regarding gifts made during a person's lifetime. Some individuals establish trusts for their children, effectively removing assets from their estate for tax purposes, but navigating the complexities of trusts often necessitates independent financial advice. The government provides numerous resources and guides on inheritance tax through HM Revenue and Customs and Money Helper. In addition to the inheritance tax reforms, Chancellor Reeves confirmed the government's decision to abolish non-dom tax status, a move that has been anticipated since Labour's commitment to tighten existing Tory plans. Non-dom status allows UK residents with foreign domiciles to avoid paying UK taxes on their global earnings, a loophole that has been exploited by many wealthy individuals. The Chancellor's plan will replace the non-dom regime with a residence-based tax system, bringing foreign earnings into the inheritance tax framework and extending the transition period for individuals to bring their offshore wealth into the UK tax system from 2 years to 3. This package of measures is projected to raise £12.7 billion over the next 5 years, as the government seeks to bolster its revenue in light of growing economic pressures. The Chancellor's announcement has sparked a lively debate about the fairness of the tax system and its implications for wealth distribution in the UK. As the government prepares for the upcoming budget, the focus will undoubtedly remain on how these changes will affect individuals and families across the country, particularly those who may find themselves unexpectedly liable for inheritance tax in the future. With the backdrop of a challenging economic climate, the Chancellor's proposals are likely to have far-reaching implications for taxpayers and the broader economy. The upcoming budget is set to be a pivotal moment for the government, as it seeks to balance the need for increased revenue with the potential impact on workers' pay and overall financial stability. As discussions continue, many are left pondering the long-term effects of these tax reforms on the future of wealth in the UK. That's all for this story. We upload videos every day covering many different subjects, so hit that subscribe button to stay informed. Thanks for watching.